This analysis is for informational purposes only and does not constitute investment advice. The United States mortgage market is a $12 trillion ecosystem. At the center of this market sits the Fair Isaac Corporation, licensing the FICO score. They operate an 88% margin business that processes no raw data and holds no credit files. They simply own the mathematical standard. For 37 years, government-sponsored enterprises like Fannie Mae required a FICO score for every conforming mortgage. In July 2025, the Federal Housing Finance Agency ended that monopoly, authorizing lenders to use a competitor, VantageScore. The incumbent, FICO, charges lenders $10 per score. VantageScore costs 99 cents. Economics suggests a 90% cheaper product, newly backed by government authorization, should capture market share immediately. Yet the incumbent remains untouched. In institutional financial markets, a government mandate is often the weakest layer of a much deeper defensive structure. The FICO monopoly operates like a fortress with 4 distinct defensive perimeters. The outermost layer is the regulatory wall. The FHFA ruling formally brought this wall down, giving lenders permission to switch scores. However, the market lacks the operational mechanics to actually execute that choice. Fannie Mae and Freddie Mac manage risk using loan-level price adjustments, or LLPA grids. These are highly specific pricing tables that determine the cost of a loan based on credit score brackets. The agencies have never published LLPA grids calibrated for VantageScore. Without these exact mathematical cutoffs, a bank cannot price the risk of a new mortgage. Regulatory permission means nothing if the supply chain cannot physically process the transaction. Beneath the regulatory permission lies the second layer of defense, infrastructural lock-in. The FICO score operates as the foundational programming language of the mortgage industry. This chart shows the mortgage value chain, detailing the 11 independent entities required to process and hold a single loan. The incumbent's algorithm is hard-coded into 7 distinct operational systems across these entities. Pricing engines, loan origination software, automated underwriting, and mortgage insurance models all execute rules that reference FICO by name. Because FICO sits at the very top of this chain during origination, its standard dictates the data format for every downstream participant. The numerical scales are not interchangeable. A 720 FICO does not statistically equal a 720 VantageScore, meaning a lender cannot simply swap the input. Adopting the new score requires rebuilding pricing engines and recalibrating decades of historical loss relationships in every software system. Industry engineers estimate this recalibration process requires 3 to 5 years of concentrated development. Replacing a standard metric requires rewriting the primary operating system of a $12 trillion market. The third and most durable layer of the fortress is the coordination problem. The industry faces a classic game theory trap. The entire ecosystem would benefit from a 90% reduction in scoring costs, but the first individual firm to adopt the new standard absorbs all the risk of transition. The major players are trapped in a circular dependency loop. Lenders refuse to originate loans with VantageScore until the GSEs publish the pricing grids. The GSEs will not publish the grids until lenders originate enough loans to generate real-world performance data. Further down the chain, investors buying mortgage-backed securities require rating agencies to calibrate loss models. The agencies require up to 18 months of seasoning data on VantageScore pools before they will issue those ratings. Without a strict top-down legislative mandate forcing all parties to switch on a specific date, no single entity possesses the incentive to move first. The friction cost of synchronizing thousands of financial institutions eclipses the direct savings of a cheaper algorithmic component. We can test this coordination theory using a scientific control group within the market itself. The non-conforming mortgage sector consists of loans held on bank balance sheets or securitized privately, completely outside the reach of Fannie Mae and Freddie Mac. In this space, there is no government mandate to use FICO. Lenders in the non-conforming market have total freedom to originate loans using the 99-cent alternative right now. Yet originators voluntarily choose the $10 FICO score nearly 100% of the time. They do this because the warehouse lenders funding the loans and the rating agencies grading the securities strictly demand the legacy metric. The non-conforming market proves the incumbent's monopoly relies on private market consensus, not government regulation. The fourth and final layer operates on the psychology and career incentives of the individual decision-maker. FICO possesses a track record of stress-tested performance data spanning 4 credit cycles, including the 2008 financial crisis. The alternative lacks this specific historical depth in mortgage performance. For a mid-size lender, switching scores saves approximately $140 per loan. This represents less than 2% of their total gain on sale revenue. If a loan originated with a new, untested score defaults, the GSE can audit the file. If they reject the underwriting, the lender faces buyback risk, forced to repurchase the bad loan at par, resulting in an expected mark-to-market loss of up to $50,000. When factoring in a standard 0.5% defect rate, the expected operational cost of this risk is $250 per loan. The mathematical risk immediately erases the $140 in savings. In enterprise procurement, the old adage states that nobody gets fired for buying IBM. In credit underwriting, FICO provides that exact same safe harbor. A risk manager who breaks industry protocol to save $9, only to trigger a massive default loss, invites immediate career ruin. Institutional efficiency rarely overrides a corporate executive's instinct for professional self-preservation. Removing a regulatory barrier does not collapse a structural monopoly overnight. We can project the timeline for this specific market by examining historical precedents of financial infrastructure losing regulatory protection. The closest analogy is the major credit rating agencies, Moody's and S&P, following the passage of the Dodd-Frank Act in 2010. Congress explicitly stripped away the regulatory mandates requiring their use. 15 years later, paralyzed by the exact same coordination problems, the incumbents still maintain over 94% market share. Without a forced transition, FICO's market share and conforming mortgages will likely experience a slow slide, retaining 80 to 85% dominance through 2031. True infrastructure monopolies endure through decades of slow, organic erosion. There is one distinct scenario that could accelerate this timeline: a top-down, legislatively enforced transition with legally binding deadlines. The immediate threat to the incumbent is not losing market share volume to a cheaper competitor in a frozen market. The actual tail risk is the incumbent's own pricing strategy. Continually compounding price hikes from $10 to $15 or $20 per score could eventually trigger severe political intervention, resulting in federally mandated price caps. A regulatory decree has opened the outer gates, but the deep fortifications of infrastructure, network effects, and human psychology will protect the core of the business for years to come.